All right, okay. Well,
Testing.
good evening, everyone. It's the evening now, not afternoon, since it's already dark. So first and foremost, I just want to recognize the incredible energy in this room. I counted there has been 10 sessions since this morning. So there's been a lot of really engaging discussions, really insightful dialogues throughout the day. And I think one thing that's really common, from just what I've heard today is that, we all share this really common goal about really going after creating really meaningful innovations to actually solving, significant problems in our planet and the society. So what better ways to wrap off this evening than to engaging in a dialogue with investors? So I'm really excited to be welcoming all my esteemed panelists today. They're not just everyday investors, they are impact investors who share your passion about creating impact, but also at the forefront of driving that investment, industry forward to allocating capital towards, impactful companies. So hopefully that we can, get more companies to help shape our future responses to climate and public health crises. So I know a lot of you have been here since the start of the day, and there's a few VF members that have joined us as well, just to get the pulse of the room so that we can get the dialogue going. How many of you here in the room are entrepreneurs or are looking to raise capital? All right. I think that's more than half. And how many of you are from the investment community? VCs, investors, angel investors? Okay, well, that's about half too. So, half and half. So we have a diverse audience in the room. I think we can touch on a lot of really engaging conversations today. So maybe let's just, get right into it, starting with introduction. I would love for each of the panelists to introduce themselves. But as you do so, please also, explain about your investment thesis, your fund, and where does impact kind of fall into sort of, that investment thesis as well? How do you define impact? So maybe we will start with Jotham.
Yeah. Hi, everyone. My name is Jotham. I'm really excited to be here today. And so really, I'm one of the senior analysts over on the team at Amplify Capital. We're an early stage impact fund that's based out of Toronto, and we invest across North America, across both social and environmental impacts. So really anything that falls into health, education, and climate tech, really in the pre-seed to Series A stages, is really kind of our sweet spot. And so really how we define impact rolls up into the UN Sustainable Development Goals. And so really specifically we target good health, good education, and also climate action. And of course, it seems like a really pretty lofty kind of goals, but we also break it down on more of a portfolio and also company-specific level, helping a lot of our companies build really specific metrics and scorecards to really understand the outputs and outcomes that they're really trying to measure.
Well, we're definitely going to be talking about the scorecards later as well. Kay, how about you?
Thanks, and it's really great to be part of this conversation today. I'm a partner at the TELUS Pollinator Fund, so we were seeded with an initial $100 million by TELUS, really to kind of deliver on the company's overall commitment to social capitalism. We can call it social capitalism, we can call it triple bottom line, we can call it fundamentally, how do we leverage the power of business to create measurable impact in the areas that are really kind of touching our lives: climate, healthcare, food security, and inclusive communities. Those are 4 areas of investment. We invest principally seed to Series A, but increasingly now we have a mandate to also go growth stage, which is really nice because then we can write kind of earlier checks and then follow the company as they grow and really leverage the power of TELUS, the hundreds of thousands of team members around the world, market leadership in agriculture, in technology, in healthcare, to unlock and open doors for the founders that we work with.
That's really exciting news. How about you, Graham?
Yes, my name is Graham Day. I'm also very excited to be here today with the esteemed panel. I work for, and I'm managing partner of Spring Impact Capital. Spring Impact Capital is a new fund that is coming out of the platform that is Spring Activator, that many of you, if you're based here in Vancouver, will know, a nationwide accelerator and incubator that's been working in Canada for almost a decade. So the fund comes out of that. Similar to Jotham and Kahe, working under specific themes, in our case, climate and health, specifically at the pre-seed seed stage. So seeing a gap there at the earliest stages where capital is required. I have a background in impact investing from a previous fund I've worked at, and so we're very excited to get going here soon on some of our deployments.
Actually, Graham, while you're at it, I would love to learn more about Spring Impact Collective as well, because Spring has launched multiple platforms. So maybe if you can touch on other platforms of investments that Spring has as well.
Yeah, I can briefly mention the collective. So the Spring Collective is Canada's only nationwide angel group specifically for impact investing. And so we're bringing together angels, some of which self-identify as angels, some of which are just learning to do direct investments, together to be able to do individual and syndicated investments into early stage companies. So that's part of our collective platform. So thanks for that shout out.
A shout out for that. I think we have a truly diverse panel today, ranging all stages of investments, and really great to hear, Kay, that you're also expanding into the growth stage as well. We have Corporate Venture Capital Fund, the largest impact fund. We have, what I call Amplify Capital. It's like the OG impact fund, because Amplify has been around the block for a very long time. And then we have an emerging fund managers who's really breaking into creating the thesis to invest in impact. So, my next question is really around, the concept of impact investing and, triple bottom line and whatnot, what you may call it, it's emerged to be really, like in this recent trends, just the growth of it is just really significant. So, from sort of this perspective, it's like, why do you think all of a sudden, startup or investors in your case are considering sort of that planet and people in addition to profit? Why has it become a trend now? So maybe start with you, Graham, because, I know the Spring Impact Collective trains, quite a few of investors and companies as well on impact.
Yeah, I'll answer this question from two sides. I think on the one hand, more and more investors, both at the I'd say institutional level, but also in individual level, are looking for more of a story with their investments to to be able to do something more than just get a financial return for it, and to align with their personal interests. Many of them come from professional industries, and whether it be healthcare, education, or some sort of science, climate science, and they're looking to align and develop their own investor thesis, which then leads itself to looking for something else, some other bottom line other than the return on investment. So I think that's coming to a forefront. So we're seeing just much more interest in that. But the other way I wanted to answer the question is, it's also, I think, good business to be a company that has that mission-led side to it. All sorts of statistics out there. I read one that 91% of millennials are more likely to switch to a new brand that is more mission-led. Nielsen had another one, said 2 out of 3 surveyed customers are willing to pay more for a brand that has a mission-led story, which speaks to better margins and better business fundamentals. So there's a whole kind of argument there for companies to be leaning in a meaningful way to the mission-led side too, which is good for investors as well.
Sustainability now sells, and it's sexy, is what I say. How about you, Kay? From corporate venture funds perspectives, we're now seeing more corporate, launching the impact funds as well, following the TELUS really successful Pollinator Fund. So why do you think it's the trends now?
Yeah, in kind of prepping for today's session, I took a bit of a step back and thought about where the notion of triple bottom line has evolved. And I'm dating myself here a little bit, but when I first graduated from school and got into corporate responsibility, this was nearly 2 decades ago. And the notion of triple bottom line was something that we had to sell to companies and saying, this is more than just marketing. This is something fundamentally what your stakeholders are looking for. And I remember as a new graduate from engineering, trying to get a job at a consulting firm and asking about the values of corporate responsibility of the company. I kind of got laughed out of the room from the HR department to say people don't care about this. It's really exciting now to know that the impact investing market, so not just from early stage venture to the corporate space, is now over $1 trillion in market size. So in those 20 years, there's been startups and entrepreneurs and founders and early investors that have been willing to make a bet and say, hey, I can make a return on our investment and create measurable social and environmental change. And this is the way the new economy is going to go, because we see the climate impacts that we're facing. We just came out of the worst wildfire season that we can have imagined, and it's kind of scary what it's going to look like next year. So why not put why not put our heads together as a company like TELUS that has all this innovation, all this commercial kind of strength, and channel it in new market opportunities where we really do need solutions that can scale, opportunities to bring products to market, and consumers that are willing and are asking for new technologies to improve their health, or to improve early warning signals for climate, or to really drive forward more regenerative agriculture practice. Fundamentally, echoing what Graham said, is it's good business opportunity, and the consumer and us, as we go to the market, supermarket, or as we choose what products to buy, we're demanding that. And no one's getting laughed out of the room now, which is a really great kind of progress over 2 years, not 2 years, but 20 years.
Absolutely. Jonathan, so Amplify Capital, I think you're on the second?
We are on our second fund.
Second
yes,
fund. But I remember speaking to the founders of Amplify, and with you as well. You know, when Amplify first started, you were like one of the very few impact-focused VC funds. And now you're seeing the growth of, you know, all the funds are thinking about incorporating impact into their thesis. You know, anything to say about sort of the growth of that?
Yeah, you know, I think it's really inspiring, and we like to think that, you know, all of the kind of early impact investors were really what caused this kind of interest in mainstream funding. When Amplify first started back in 2016, it was actually seeded by Richard Branson. He actually came up to Canada, was looking around and saw that there wasn't really any players in the impact investing space, and so he kind of seeded us first as a Mars Catalyst Fund, and we eventually spun off as Amplify Capital. I mean, really at the time, you know, Catherine Mortzman, who's our managing partner today, she really wanted to be able to align to the triple bottom line, because there was no other way to get people to pay attention to us unless we made a lot of money doing a lot of impact. And so now when heads are turning, a lot of these large fund managers, we hope, are actually looking to us and saying, hey, what are they doing that's different, that's providing all of this new value to stakeholders and also to shareholders as well.
You know, that gives a really nice segue to my next question, actually. So as VC investors, you know, we have this, I include myself as the VC by past life. We have this fiduciary duty to return investments and make the best decisions, right, on that would result in the financial outcomes that, you know, our investors need to see. How do you evaluate sort of that environmental and social considerations, that impact side of things? You know, what are some of the metrics and indicators that you look for to help you make that decisions? And actually, I'm going to start with Kookai, because I know that TELUS Pollinator Fund has launched something for entrepreneurs.
Yeah, so I'll answer that kind of in two parts. So for us, we do look very closely at the financial returns. We'll go through financial projections, and we'll really try to understand how is your impact thesis integrated as fundamentally for every dollar of revenue you're going to generate. So I'll use an example of a company called Flash Forest. It's a drone-based reforestation company, BC-based. And we know that for every tree that they're going to plant, that's going to directly reforest post-wildfire landscapes, and it will also remove carbon from the air. So we'll make really early assessments of the impact, and we'll align that with the projections of the financial model as well. So we have a sense that if we're making an expectation of a financial return based on revenue growth, this is the equivalent environmental return that we are going to have as that company scales. We'll do that across agriculture. We'll look at sustainable agriculture. We'll look at areas of, under sustainable management, amount of waste reduced, et cetera, whatever it may be. We'll do that in healthcare, and we'll do that in ed tech and inclusive communities as well. The one thing from an investor perspective, there's been a lot of effort and a lot of collaboration among the investor space in the last 10 years to really say, as an investor, do we assess it, and how do we really understand and validate the credibility of the impact claims that companies are making. And I think we've made a lot of good progress here. There's IRIS that's come out to really define a standard taxonomy. There's the 5 dimensions of impact. So investors in general, and I don't know if you guys would disagree, but I feel like we're coalescing around a conversation that we all kind of generally know what impact means and have a methodology to measure. The area where we think that it's actually hardest is for all the entrepreneurs that are out there right now, trying to start a business, trying to articulate your impact thesis, and try to lean into that impact angle of your business and access capital that you otherwise wouldn't be able to do. So if you're a founder in the audience today and you're like, I have a climate business here, and I'm raising $1 million or $2 million seed fund, how do I attract impact capital? We've created a tool, and it's a really simple playbook that helps you as a founder. You can download on our website, telus.com/pfimpact. Little plug there. But it will help you articulate using standard frameworks that as investors we understand and accept as impact. And then it will also create, very simply in Google Sheets, templates for a reporting form for you. So no investor is expecting your impact to be perfect from day one. We expect it to evolve and for it to reflect the learnings as your company grows. But we know that you need a starting point. And so having a playbook like that helps you not only articulate what you already are doing, but also asks you to reflect on areas where you could be improving, and then gives you a template for reporting. We hope it's going to be really easy for you to just load it up into your data room. So when an impact investor says, hey, well, how do you approach impact? You can say, here is what we've already done. We'd love your input as well onto how else we could evolve that. But you've already had kind of a baseline set of metrics or articulated your thesis in a way that, for us it's easy to recognize and have a conversation from.
Graham, how about you? Because sometimes you get involved really early, that pre-seed stage, and I know that you constantly always have conversations with entrepreneurs who may not be at that stage of like incorporation yet. You speak to entrepreneurs who are thinking about starting and launching their companies all the time. Like, what metrics or what indicators are you looking to assess, especially when it's so early?
Yeah, it's interesting, right? So it's almost the creation of the indicators is separate from the data that comes from those indicators, because for many companies, there is no impact yet because it's still at a pre-seed seed level, or it's still in piloting, or it's still in the lab. So in those cases, I'm very interested in how the impact thesis is articulated. And one way to do that is through a tool often called an impact model or a theory of change, and it's actually built into the tool, TELUS's tool, where you can show what you have, what your inputs are, what the activities, what you're going to do with those, what that's going to create in terms of outputs, and then what ultimate impact that has in terms of outcomes. And it's a powerful way to show the threads through and expose in a good way the assumptions you're making as a founder of how you're going to get there. And then what comes out of those assumptions is a set of questions and a set of indicators often. And so for me, my attention is caught in a good way by founders who are saying, look, this is what I plan to do. This is how I'm going to get to the impact. And I'm going to know I'm going to get there because this is what I intend to measure. And even if they're not measuring it yet, because as I mentioned, it might be pre-launch, that really satisfies a lot of my curiosities around how mission-led the company is. The fact that you're planning on measuring it and have thought through what is a huge comfort for, I think, the impact investor community to know that you're thinking about it.
And for the entrepreneurs in the room, that's the theory of change. It's very common used in nonprofit organizations. Investment funds actually also use it as well for our theory of change and how we come up with the investment thesis. How about you, Jonathan? You mentioned a little bit in the introduction that Amplify also has created some frameworks and some tools to help entrepreneurs as well.
Yeah, I mean, like Kookai and Graham have mentioned, there's no like generally accepted principle for reporting on impact. There's no auditors auditing your impact either. And so we're all kind of trending in that direction where, carbon accounting, there are some, emerging frameworks and principles that are being more widely adopted, there's nothing really in that kind of social side. There's no one coming in to say, hey, you have like 1 million learners, check, that's right. And so really what we see is there's kind of like a little bit of a spectrum of founders. There's ones who kind of come to us already with models with like 10 pages of assumptions on like a one-sheet spreadsheet, and that's totally fine. And then there's others who actually don't want to give us any of their total addressable impact or any of their kind of projections because they're worried that those numbers aren't accurate and therefore they don't want to report on it. But I do think it is more important to have those numbers and change it as they go and build also this kind of impact roadmap and milestones for what you want to measure, when you want to measure it, as concurrently with your product milestones and financial milestones as well.
Thank you. So I kind of want to move into some of the examples. So, would love to maybe hear, from your own portfolio companies you've invested in, or maybe some of the pitches that you've listened to and it just kind of stuck with you. What has been some of sort of like that key contributors of, really successful pitch, especially around impact? And maybe can you give example of, if that company's got your investments? So starting with anyone, maybe Kookai? Yeah.
Sure, I'll give one, and I think this is overarching for any kind of pitch. We want to learn something from your pitch, and so if you're coming to us with an idea and help us understand why, or learn more about the topic, because we're looking at 1,000 kind of pitches. And so anything you can do to help us deepen our understanding of that area would be really useful. So I'll give you an example. We just closed an investment into a company that does early wildfire detection. They use IoT sensors connected via LoRaWAN network, so they can be placed where there is no, in rural areas where there is no 5G connection. And can have early wildfire detection up into a minute. For me, as I was going through that pitch and looking at their data room, the founders had gone into such detail of analysis around timeline of smoldering, for when a spark might happen, to smoldering, to when a fire will expand, to the economic impacts of a wildfire, suppression, insurance. So really had scaled up the initial challenge of a wildfire starting to the overall thesis, where if we can detect a wildfire within an hour of its smoldering, we could save billions of dollars in wildfire suppression and economic loss. So it was just that logical math, if you will, between this fire detection time to this type of economic impact that was really compelling for us, because it meant, and I think Graham talked about it, a real clear intentionality from the founding team that this is what their company is wanting to do, and they're not just putting impact there as an impact washing kind of strategy. So when there's that level of thinking, even if it's not accurate, and I think Jotham, you kind of alluded to it, we don't expect your projections to be, to pan out the way you see it. Things will always adjust, but we want to know that you've at least had that intention around impact and that you've taught us something through our pitch process.
Yeah, I always think that all of our founders in our portfolio see the market a little bit differently than everyone else, and so I'll probably give the example of Musim Education, which is, if you can imagine like a Netflix platform for social emotional learning, that's basically what they are. And what we've seen in the industry is that he had a very, very interesting and deep backstory of his daughter actually going through some very severe mental illnesses, and he actually quit a very cushy lawyer position to kind of start this business. And so he gave up on his career and pivoted out of inspiration. And so what he saw differently was really the delivery in social emotional learning education. It's actually been around for decades, but it's never really caught on, and it's never actually had the intended learning outcomes that we see in schools today that people are really looking for. And the delivery through live actors, surprisingly, actually had the effect of enabling children to see themselves in a diverse cast instead of delivering it through paper and pencil, through cartoons, or other methods. These students can actually empathize and sympathize with the characters they see on screen. And it's not just about the content delivery, but it's also about the learning outcome tracking that they then put back and report back to their stakeholders, to their investors, and to their shareholders as well.
Yes. I want to give another example. This is actually a company I used to work at, and I'm going to give the example because I wanted to make a point on impact measurement and how you're not measuring just for us, your investors. You're ideally measuring your impact because it's business intelligence for you to make your product or service better in all senses of the word. So I used to work as CFO for a scale-up called Sistema Bio, and we made, and the company still makes today, small biodigesters for smallholder farmers around the world that turn farm waste into biogas, which is a form of, can be used as cooking gas. And so we would work with our investors who were asking questions about, well, exactly what is the impact of this? And we would say, well, we know this much biogas in theory replaces this many tanks of gas that the farmer would otherwise purchase. Great. And so we had our kind of model of how that would work, and it was very kind of linear. This many biodigesters, this much gas we would displace, this many savings that these farmers in Mexico and Kenya and India would save. And our investors pushed us to do that impact measurement a little bit deeper. And so through partnerships and surveys we would learn much more granular detail about exactly what was the system displacing. Was it displacing firewood? Was it displacing different types of gas? How much time? And the more we learned about that, the better we could price the product, the better we understood the value that we were providing those farmers, the better partnerships we could make. And so it's a good example of, we're not measuring impact for the sake of a report. We're measuring it in many ways for the business intelligence and to improve the company in the long run. So yeah, just keep that in mind because it can very often become this repetitive, formulaic, something that ends up in a report somewhere that gets sent away, and ideally it's much more than that.
Or like the exercise, like the checkbox and whatnot. So, and yeah, in turn, you do the exercise, you attract customers, and you might get investors along the way as well. I really love all the examples that you shared because some of the companies, especially in your portfolio, you may always hear the entrepreneurs saying that, well, my companies are so impactful. We're helping solve such significant problems, but we have just so much problems getting that attention from investors because our problems are complicated. It's wildfires, it's mental illness, it's something that underserved communities. It's not like the sexy EV cars or something that is more mainstream. So thank you for sharing all the examples. And I think for investors in the room, it probably helps them think through as well in terms of how do they make decisions? How do you make decisions when it comes to impact and also investments? So I have my Slido queue here. So for the audience in the room, is it online as well? Oh, and people at home, please submit your questions here. I'm just going to go through the questions. I cannot see that, so I'm going to go here. So many articles, okay, it's moving on me. So how do your firms decide which companies align with the 3 Ps? What percentage of profit is acceptable without negatively affecting people and planet?
That question seems to imply that there are trade-offs, which is something we haven't talked about today, and it is an excellent topic to dive into. We may never come out of it, but we can try. I just say in general that I think this is something that should be discussed openly with investors. It is an interesting topic that opens up governance. Who do you want on your board? How do you steer things? Because I think we all named examples where revenue and impact move nicely together, and that is almost always true, but there are lots of decisions that companies need to make where one might be sacrificed over the other. If you're pricing a product for access and you're being pushed by an investor to increase margins at the expense of access, you're making one of these decisions where you're, in theory, putting profit over people. So we don't have any rules of thumb on it. It's something to be actively discussed. It's something to watch on your governance, who's at the table. It speaks to how you want to seek alignment with the investors that you're bringing on board right from the beginning, because yeah, this is something that will come up.
Jotham, you were going to jump into this, the trade-off questions as well.
Yeah, I mean, yeah, I love talking about this, but Graham did a really good job encapsulating it. And, you know, I think the whole premise behind our fund is that you can do the triple bottom line, do impact investing, and also provide a very large profit or return to your investors as well. And so, you know, I'll give an example. So yeah, I'll go back to the original question. I mean, some of our companies actually, we're finding more and more, a lot of them are actually not just in our 3 sectors, but they actually are covering multiple of our sectors. So I'll use the example of Future Fields, which uses fruit flies to actually grow recombinant proteins and other small molecules. And essentially the play for using fruit flies is that you're able to produce the same content at 1/10 of the cost and also at even better performance. And also at the same time, they're a lot easier to produce and much lower carbon emissions as well. And so in this case, the more actual recombinant protein that they're able to sell, the larger the impact and the larger the profits. And so I think this is a counterexample to Graham's, where in this case it does actually the profits and also the impact does scale together.
The questions are moving, so
Yeah.
okay, maybe to comment around sort of that trade-off questions as well. Like, I mean, does TELUS Pollinator Fund ever consider, like, you know, percentage of profit or anything related?
We don't, and and part of my hesitation right now is if you're investing in the earlier stage, those decisions may not be some of the strategic considerations that you may have to make at a later stage when kind of, you know, do you go for more inorganic growth? Do you really kind of push and expand into new markets? So I think right now we've been able to invest along our thesis where revenue and impact have to be tied very closely, and that's really critical for our process. But it's also really key, I think, to what Graham and Jotham are saying is the conversation about whether or not impact matters to the founders. So that's really important part of the diligence we go through is there a lived experience from the founder? Because usually that will create that like long-term commitment. Is there a tenacity of the founder to say, this is something where, you know, I've been working, 90 hours a week, and for the last 5 years, I really, for me, it's either going to be, you know, this growth of company and impact, or I'm not going to do it. So I think that's sort of that founder alignment, and for the founders out there or investors out there is, like, are you having honest conversations with your prospective founders or with your prospective investors? And if you have a gut feeling, that's like something's niggling here, you know, we may at some point, you know, not see eye to eye on that impact piece, then, you know, it's important to kind of, you know, explore that, surface that. Otherwise, as you do kind of go to some of the later stage kind of conversations or some of the harder conversations, you know, you're not anchored in core values that will ensure the impact piece is integral.
Yeah, that's a really important point because, you know, VC funds don't invest alone. You know, you form a syndicate with other funds and, you know, and it's not just the rounds that you're raising as well, it's also the future rounds. And so who you bring to the table, you know, that may change the narratives around the growth and the profit and the impact side of things. But I really love the point you talked about how, you know, it's really the founders, you know, who are kind of like the core, right? Like staying true to the mission and the vision that they started with. So that's a really good point. So now the most important question, what is your average check size?
I love how this at the event, the most number of upvotes.
The most
I love
important
it. It's like
question.
founders. They're just
How
hustling
did we
all the
miss
time.
this?
It's great.
So,
All right.
So to make sure everybody stays till the end of the panel, we'll answer this last.
We're actually going to do this.
Okay,
No,
I'm kidding.
Okay, what is your average check
So,
size?
I'm happy to go first. So our first check size will be between $250,000 and about $450,000, and then we have reserve capital for follow-on as needed.
Any condition? You know, stages of the companies. You got to show X of, you know.
So it's okay for it to be pre-seed, it has to be, in general terms, out of the lab with the toe into the market, so some understanding of product market fit, but we are able to come in pre-profit and even pre-revenue. So.
Our sweet spot has been around $1 million to $2 million, but we've written checks larger than that, especially if we can see a strong strategic alignment to TELUS's capabilities, and we can really help the company grow. So we have ability to write larger checks, and I'll leave it at that.
And so for Amplify, we write checks usually between $500,000 to $1 million, and we also reserve capital for follow-on investments as well.
I love how we're all like stitched together. We barely overlap. It's perfect.
Yeah, that's
put her in. The whole
And
suite.
Jotham, any condition, like, what traction? Founders, I got you. I'm going to dig in for you. Any traction that you like to see? What sort of that,
Well, honestly, I think the first and foremost, we look at kind of the tie, so total addressable impact has to be in the gigaton or millions of learners or improved patients with improved health outcomes. In terms of traction, we do invest in pre-seed all the way up to Series A, so it does kind of vary, but typically, TRL 3 to 7 in climate and more deep tech startups, and some revenues or like pilots and proof of impact for health tech and also ed tech as well.
Wow, I love the total addressable impact. I mean, that's really awesome. All right, so the next question talks about, many articles talk about, the evidence that, ventures investing in with ESG, SDGs, the impact side of things show stronger performance. So can the panel talk about this in kind of in relation to the triple bottom line, so relation to the performance of the funds in impact space? Maybe not your funds, but overall trends is fine too. Yes.
Yeah, I'll pop into here around this concept of DEI. I think if you look at the venture sector, diversity is, to be frank, a bit dismal in the sense that if you're a woman founder, you're going to get 20% of the deals funded from capital perspective. 20% from the deals funded and 3% of all VC funding. And we know, that's not the proportion of innovation across the gender makeup of communities. And if you're a racialized founder as well, your access to capital is just, you're facing a lot of headwinds. It is changing, I think, and I think it's really exciting. I think Spring's done a lot of great work around really intentionally supporting kind of women-led founders, Amplify very similarly as well. And I think a lot of Canadian kind of funds in that same space, and then a lot more also kind of either kind of diversity anchored funds out there, really creating a much easier roadmap for founders to access capital and have conversations with funders that otherwise would be very difficult. For Pollinator, our DEI, we've been really excited that because of the nature of impacts that we've been chasing, we've also come across a lot more diverse founders. And our portfolio right now, about 42% are led by women, and 54% are led by racialized Indigenous founders. And I think a big portion of that is because of the conversations that we have with founders, and we really want to understand if the impact is core to their raison d'etre when they get up in the morning. And if you've had a lived experience around social and emotional learning kind of shortfalls, or around hard access or limited access to healthcare, or you're disproportionately impacted by climate effects, you may be from more of the less mainstream kind of VC market. And we really value that lived experience. And so, our hope is that we can continue as our portfolio grows to really kind of rebalance and show the opportunities within diverse founders and continue to collaborate with different platforms that are channeling earlier stage investments and priming the investor market to recognize opportunities within founders that don't fit the traditional mold of VC funds.
Yeah, I definitely agree with what Kehe has mentioned, and I see it more from like an operational standpoint actually, and seeing half your women I'm sorry, half your team can be women, but how many are on the executive team or the C-suite, for example? And we found that actually across the board, all of our companies who have reported, their performance, their SDGs to their employees, for example, have had very, very little turnover. And so really starting from kind of grassroots, being very intentional and thoughtful about how you engage with your employees and your stakeholders through, ESG, like B Corp, all of these different methodologies and certifications, you can actually perform better because you have better ideas that rise to the top, more engaged employees, and by doing so, you have just better profits overall and more impact.
That's so interesting. We're also believe that there are all sorts of groups of what we call overlooked founders that have tremendous value, and so in that sense, you could kind of map a kind of performance to that. The other thing I just briefly mention is there are a lot of markets being made right now around challenges that we have. So you mentioned forest fires, and you look at the different SDGs out there, markets being made around carbon by policy, water microplastics. A shout out to UBC company, Veritas Research, you know them, that work on degrading microplastics. That a lot of that business model will be enabled by legislation banning microplastics going into water supplies. So it's an interesting, we are intertwined with policy and government is slowly but starting to answer some of the calls that we see around global challenges that are encapsulated in those SDGs. And so naturally business models that are angled towards those have tremendous opportunity for companies and for investment.
All right, so I see the sign that there's 2 minutes to close. So maybe just do something fun here. And I didn't prep you before, but as investors, as individuals, you must have some areas that you're most excited about in impact. So maybe just one word so that the founders can find their ways to you afterwards at the networking areas. What excites you the most right now in terms of areas? Just maybe one word, categories, whatnot. Or the impact outcomes, however you might want to take it.
Just one?
Okay, 3. I've been thinking about this before, so maybe 3. 3 might be too hard. Max 3. Starting 2. Or max 3.
Oh my God, 8
Starting-
seconds.
Starting
Regenerative
from
agriculture. Very passionate about
Regenerative
food.
agriculture.
And,
Synthetic biology.
Right now, digital MRV for carbon solutions.
MRV.
Monitoring, reporting, and verification. So we're seeing a big trend and shift, obviously growth in carbon credit markets, but the whole market needs to be underpinned by scalable technologies that can really verify whether or not a carbon credit has actually been captured or not.
Oh, I've got a good company for you.
All right, this is only just one example of the many of the areas that you invest in. So we heard so many keywords today, and this is my key takeaway because I like to remember things in keywords. Total addressable impact, chasing impact, lived experience, and just good business, bottom line. And I just really love that because I think it really resonates well with, the people in the room today. And hopefully founders, investors alike, can walk away with really meaningful insights to, incorporate it into how you start your companies, you grow your companies, attract investments, but also consider about, forming your investment thesis when making investments as well. So thank you to our panelists. Special shout out to Jotham, who came all the way from Toronto, Graham, who came from Victoria, and of course, Kahei, who came from Vancouver.
Two blocks away.
Yes.